The euro just broke below a critical institutional pivot, and the smart money is already positioned short. EURUSD collapsed through 1.1522 after US ISM employment surged to 52.8. But here's what the headlines aren't telling you. COT data shows hedge funds are piling into dollar longs at the fastest pace since March. The 1.1450 level is the last line of defense before a potential freefall toward 1.1368. I just released a full breakdown with exact entry levels, stops, and profit targets for both scalpers and swing traders. The institutional positioning data just crossed my desk, and what I'm seeing in the euro to US dollar tells me that yesterday's 0.17% decline to 1.1509 is more than just a routine pullback. This is a structural shift, and if you're not paying attention to the flows right now, you're going to get caught on the wrong side of what could be a significant move lower over the coming sessions. Let me be direct with you from the start. The euro's break below the daily pivot at 1.1522 is significant, but the real story is what's happening in the commitment of traders report and the institutional order flow that's been building underneath this price action. I've been watching this setup develop for the past 2 weeks, and the convergence of technical breakdown with institutional positioning tells me we are looking at more than just a temporary dollar bounce. My weekly bias on euro to US dollar is firmly bearish with a target of 1.1450, and potentially lower toward 1.1368 if the 1.1450 level breaks. The invalidation level for this bearish thesis is a sustained close above 1.1578, which would suggest the bears have lost control and we are heading back into the consolidation range. Here's what I'm watching as my primary tell, the 1.1500 psychological level. If we see a clean break below that with conviction on the 4-hour chart, I expect accelerated selling into the 200-day moving average at 1.1450. But if we hold above 1.1500 and start building higher lows, then we might be looking at a false breakdown that traps the late shorts. Institutional traders often use these psychological levels as staging points for larger moves, and I've seen this pattern play out multiple times in my career. The difference this time is the underlying flow data. It's not just retail sentiment that's bearish. The smart money is leaning the same way, and that changes the risk-reward calculus significantly. Let me start with the weekly chart because this is where the macro picture really comes into focus. The monthly trend has turned bearish as we correct lower from the yearly highs near 1.1915 down to current levels around 1.1509. What stands out to me on the weekly timeframe is the decisive change of character we've seen in recent weeks. That's not just normal consolidation, that's a structural shift in the trend. The weekly chart shows price breaking through structural demand zones that previously held support, and we are now trading below key moving averages including the 5-week, 10-week, and 20-week averages. This is a textbook bearish setup, and the momentum indicators are confirming the shift with negative MACD divergence that's been building for the past month. Now, moving down to the daily timeframe, what I find particularly compelling is how prices reacted to the recent rebound attempt. The bounce we saw on Friday was sharp, but it lacked conviction. It was a classic dead cat bounce that got sold aggressively into. The daily RSI at 43.15 confirms sellers are in control, and the negative histogram expansion beneath the MACD 0 threshold suggests this bearish momentum has room to run. What I'm really focused on is the relationship between price and the 100-day moving average at 1.1510 versus the 200-day at 1.1450. You'll notice we are currently trading between these two major moving averages, and this is where institutional traders often look for directional clues. The fact that we are below the 100-day but still above the 200-day tells me we are in the early stages of a trend reversal rather than the late stages, which suggests more downside potential remains. Let me zoom into the 4-hour timeframe because this is where the battle is truly being fought. We are maintaining a continuous pattern of lower highs and lower lows beneath a descending resistance line, and this descending channel has been guiding price action with remarkable precision. The ADX at 21.40 indicates a developing, mid-strength directional bearish trend, which tells me this isn't just noise. There's actual momentum behind this move. What I find particularly interesting is the way price has reacted to the 1.1522 pivot level. This level served as support during the Friday recovery, but it's now acting as resistance, and that role reversal is a key technical signal that institutional traders watch closely. I've seen this exact dynamic before in similar market conditions, and it often precedes an acceleration lower once the pivot is firmly rejected on the 1-hour time frame. We are seeing accelerating localized downtrend momentum that's being driven by structural dollar flows. The lower highs and lower lows are clear, and price is hugging the descending resistance line, which suggests bears aren't letting up. The Williams %R at -72.10 is positioned in heavily oversold territory, but that doesn't necessarily mean we'll get a bounce. In strong trends, oversold conditions can persist for extended periods as the trend continues to grind lower. Now let's look at the moving averages across these timeframes because this is where the confluence becomes compelling. On the daily, the MA5 at 1.1518 and MA10 at 1.1527 are both signaling sell, while the MA20 at 1.1534 and MA50 at 1.1545 confirm the bearish bias. The only buy signals are coming from the MA100 at 1.1510 and MA200 at 1.1450, but given our current position below the 100-day, even that support is starting to look vulnerable. The MACD on the daily timeframe shows a negative histogram that's expanding beneath the zero threshold, and the stock at 38.20 is maintaining its bearish signal with the %K line holding beneath the %D baseline. This is textbook momentum divergence that supports the bearish case, though I want to add one personal observation here. What I'm watching most closely is the relationship between euro to US dollar and the 10-year yield spread between US Treasuries and German bonds. In my experience, this spread has been the most reliable leading indicator for major euro moves, and right now it's widening in favor of the dollar. This isn't just about the headlines, this is about the underlying flow of capital that follows yield differentials. The fundamental picture right now is all about policy divergence, and this is where the institutional flows are originating. The euro broke lower into the low 1.1500 region after solid US ISM manufacturing employment numbers clambered to 52.8, providing a sudden technical cushion for the greenback. But that's just the headline trigger. The real story is deeper. What the retail news isn't telling you is that localized volatility is being directly guided by spillover flows stemming from heavy joint currency interventions enacted by Japanese and US authorities to reset unhedged global dollar positions. This is massive, and it's creating structural shifts across G10 currency baskets that are rippling through the euro to US dollar pair in ways that aren't obvious from a simple technical analysis. The key economic data we are watching this week starts with tomorrow's US JOLTS job openings report, where the forecast sits at 7.5 million. Let me tell you what I'm looking for here. If we get a reading above 8 million, I expect the dollar to rally significantly because it reinforces the tight labor market narrative that gives the Fed cover to maintain its hawkish stance. A number below 7 million, however, could trigger some short-term dollar weakness as traders price in a more dovish Federation. Wednesday brings the US ISM services PMI and Eurozone retail sales, and this is where the divergence story really comes into focus. The Eurozone economy is showing improvement with Q2 GDP at plus 0.4%, which initially fueled calls for an ECB policy move. But here's the institutional perspective that's driving flows. Persistently sticky US inflation at 3.5% versus Eurozone's 2.8% is giving the Federal Reserve room to hold higher for longer ground. This caps multi-week euro relief rallies, and it's the primary reason I'm not looking for any sustained euro recovery until we see a significant shift in this differential. And of course, the highlight of the week is Friday's US non-farm payrolls report. This is going to be a major market mover, and I want you to think about the institutional positioning leading into this release. Hedge funds and macro desks at major banks like Deutsche Bank and Morgan Stanley are pointing out that any NFP print above 200,000 is likely to trigger another leg lower in euro to US dollar as it reinforces the employment strength narrative. Eurozone producer price index data is also on the horizon, and traders are pricing in a contractionary bias that's capping the euro's recovery upside. This is important because it's creating a feedback loop. Weaker PPI suggests weaker economic activity, which reinforces the case for ECB dovishness, which weakens the euro, which feeds back into expectations of further weakness. I've been trading through NFP weeks for 2 decades, and I can tell you that the institutional positioning ahead of these prints is often more important than the print itself. Right now, The smart money is positioned for dollar strength, and that means any NFP number that doesn't completely disappoint is likely to trigger continued euro selling. Now let's get into the actual trade setups, because this is where we turn analysis into execution. I'm going to give you 2 scalping setups and 1 swing trade with exact levels, triggers, and risk-reward ratios. Scalping setup 1. Short relief rally. This is my preferred setup for the next 24 to 48 hours, and it's based on the structural downward momentum we are seeing across multiple timeframes. The trigger is straightforward. Look for short entries on relief rallies that fail to crack the immediate structural resistance wall at 1.1522, daily pivot, or 1.1543, R1. The key is waiting for the rejection and then shorting into the weakness. Entry trigger. Price rallies to 1.1522 to 1.1543 range, shows rejection candle on 15-minute chart, then breaks below the low of that rejection. Stop loss. 12 pips above the local 1-hour lower high at 1.1555. This gives you a tight risk parameter of roughly 20 to 30 pips depending on exact entry. Target 1. Secure profits sequentially at the 1.1484, S1, structural base. Target 2. 1.1450, S2, institutional support level. The risk-reward ratio on this setup is excellent because the stop is tightly defined and the first target is reasonably close, giving you a 1 to 2 to 1 to 3 risk-reward depending on exact entry. What I like about this setup is how clean the technicals are. The descending channel is well defined, the resistance levels are clear, and we are seeing consistent lower highs that give us confidence in the short thesis. I've traded the same pattern on euro to US dollar many times, and it's been consistently profitable when the institutional momentum aligns with the technical signals. Scalping setup 2. Breakout continuation. This is a more aggressive setup, but it's the one I'm personally watching most closely for the 1 to 2 hour time frame. The idea is simple. If we break below the 1.1500 psychological level with momentum, we chase the breakout down toward the 1.1450 support. Entry trigger. Clean break below 1.1500 with 15-minute candle close below the level. I want to see accelerated momentum and increasing volume. Stop loss. Above the breakdown candle high, typically 15 to 20 pips above 1.1500. Target 1. 1.1484, S1, for a quick scalp. Target 2. 1.1450, S2, for a longer hold. The risk-reward on this setup is at least 1:2, and in the current momentum environment, it could easily run to 1:4 if the NFP positioning flows continue. Here's the insight that makes this setup interesting. Institutional order flow is suggesting the 1.1500 level has become a focus for stop-loss hunting. We've seen this pattern before in my trading career where the psychological levels become liquidity traps. Smart money likes to push price through these levels to trigger retail stops, then use that liquidity to build larger positions. If I see this happening, I want to be following the momentum, not fighting it. Swing trading setup. Descending channel rejection for the swing traders among you. This is the setup I'm building a core position around. The strategy is to wait for clean multi-day retests and rejections of the upper descending trendline boundary spanning 1.1578, R2, to 1.1665, R3, and then short the rejection. Entry trigger. Price rallies to the upper channel resistance area, shows a clear rejection pattern on the 4-hour chart, and then breaks below the previous 4-hour low. This is about catching the continuation of the downtrend from a favorable entry point near the top of the channel. Stop loss. Above the rejection high by 20 to 25 pips. This provides a clear invalidation level that prevents you from getting caught in a sudden reversal. Target 1. 1.1450, 200-day MA. Target 2. 1.1368, S3. The risk-reward on this setup could be 1:3 or better if we reach the S3 level, and the 200-day MA provides a logical profit-taking zone that institutional traders often use. What makes this swing setup compelling is the confluence of technical and fundamental factors. We are at the upper end of a bearish channel, fundamental flows support dollar strength, and institutional positioning is leaning bearish. This is the kind of setup where if it works, you can hold the position for several days to a week and capture a meaningful move. I want to be clear about one thing. I'm not recommending anyone chase the market lower from current levels. The risk-reward is better on rejections from the upper channel boundary, and patience is the key to successful swing trading. I've learned this the hard way through years of trading. The best trades are the ones where you wait for the right setup rather than forcing a trade when the levels aren't optimal. Between these setups, I want you to understand something about how I approach the market. I'm not trying to catch every pip of every move. I'm looking for high probability setups where the technicals, fundamentals, and institutional flow all align. When they do, I scale in with conviction, but I'm always mindful of risk management because even the best setups can fail. Let me take 30 seconds to talk about risk because this is the most important part of any trading plan, and it's where most traders make their biggest mistakes. Every trade I've outlined today comes with a specific stop-loss level, and I want you to follow these religiously. If you can't stomach the risk, you should not take the trade. That I've learned this through painful experience. Early in my career, I held on to a losing position thinking the market would come back, and I watched a manageable loss turn into a portfolio-damaging drawdown. That experience taught me that the best traders aren't the ones who are always right. They're the ones who limit their losses when they're wrong. For each of these setups, I recommend risking no more than 1 to 2% of your account per trade. This is the institutional standard, and it's what allows you to survive the inevitable losing streaks and still have capital available for the winning trades. The R ratios I've given you mean that even if you're right only 40% of the time, you'll still be profitable over the long run. One more thing, don't move your stops in the direction of your trade. I see retail traders do this constantly, thinking they're managing their risk, but what they're really doing is exposing themselves to larger losses if the trade reverses. Set your stop based on the trade setup, and let the trade play out. So let me summarize what we are looking at for euro to US dollar. The bearish bias is clear from the technicals, fundamentals, and institutional flows. The key level I'm watching right now is 1.1450. This is the 200-day moving average and the S2 support level, and it represents the last line of defense before a potential freefall toward 1.1368. If we hold above 1.1450, we could see a relief rally back toward the 1.1522 area, but those rallies are likely to be sold aggressively. If we break below 1.1450, I expect accelerated selling that targets the 1.1368 level, and potentially even lower toward 1.1280 if the dollar momentum continues. Make sure you're subscribed and have the bell notification turned on because I'll be releasing a detailed NFP preview on Thursday that's going to be critical for positioning ahead of Friday's jobs data. I'm also going to be doing a live Sunday weekly preview where I'll update these levels based on the week's price action and institutional flows. Before I close, I want to leave you with one final thought. In my 2 decades of trading, I've learned that the best opportunities are often the ones that feel uncomfortable. The setup today feels uncomfortable because we've had a big move and most traders are thinking about buying the dip. But when institutional flow and technicals align, the uncomfortable trade is often the right one. Now I want to hear from you in the comments. Are you watching 1.1450 as your key support level, or are you expecting a bounce from current levels? And what's your NFP trade plan? Let's build a community map of where everyone's positioned, and I'll share my institutional order flow read in the replies. Remember, the market doesn't care about your opinion. It only cares about levels, flows, and momentum. Stay disciplined, stick to your stops, and I'll see you in the next analysis.